I have been saying for years and years to clients that hating the president is not an investment strategy, or not one that works anyway. The stock market is not red for Republican or blue for Democratic. It is green for earnings and green for profits, full stop. When I came into this industry over a dozen years ago, it was back then, should we sell all of our investments and go to cash if Obama gets elected? Because he's a socialist and no way can the market do well. That would have been a tragedy, of course, because the market did extremely well under Obama. Then when Trump got elected, it was the same type of rhetoric from different clients, of course. Shouldn't we just go to the sidelines, Michael, because Trump is way off his rocker? He's not a socialist, but he's a sociopath. Again, this would have been a tragedy as the market continued to do well under Trump. Reacting to the US president is a fatal investing mistake, as the market does not seem to care who is in the White House. It always has been and always will be nothing but white noise. Focus on what you can actually control, like how much am I spending, how much am I saving, how much am I paying in investment fees, how much am I paying in taxes, or how much risk am I taking in my portfolio. These are all variables we can actually influence and control. Who's in the White House, we have no control over. The bottom line is that investors would be well advised to avoid mixing politics and investing. While the dysfunction that occurs in Washington, D.C. is somewhat frustrating, it's all a distraction. When you buy the S&P 500, you're entrusting your life savings to the 500 best business operators in companies who are able to consistently grow their earnings and make our lives better. When you buy the stock market, you aren't investing in the U.S. economy or GDP. You're investing in real companies with real cash flows. Are Americans going to stop going to see Taylor Swift, or stop going to McDonald's, or stop buying iPhones because of who gets elected as the next president? Absolutely not. As a starting point, if we use the S&P 500 as a barometer, an election year has historically been a very good year for stocks. Call it optimism, hope for the future, or simply a coincidence, but if we go back to 1926, the S&P has earned 10.3% per year. If we look at years that a presidential election took place, 20 of 24 years since 1928, the market was positive. And on average, the S&P earned 11.6% in these election years. When you're investing in the markets in a diversified way, you're going to win over time, much like the house wins in Vegas. If you have one big night in Vegas, we all know the house wants you to keep on playing because the odds are, of course, stacked against you. Owning a diversified portfolio is the exact opposite. The longer you play, the more likely you are to win. Where in a casino, of course, the longer you play, the more likely you are to lose. At Brandywine Oak, wealthy families hire us to manage their wealth responsibly and not react to the latest narrative. Always be skeptical of the narrative. And remember, hating the president is not an investment strategy. Buy the market and hold it forever, add to stocks when they occasionally go down in price, and ignore everything out of Washington, D.C. Your personal behavior, not the result of any election, is more likely to impact your performance over the long haul. We can never control what actually happens, but all we can control is our reaction to what happens.